So, good day to all. In this video, we are going to see management accounting suggestion answers for June 2024. So, now we are going to see section A. So, which one of the following statement is false? So, we need to identify the false statement. So, management accountant uses cost accounting tools and techniques for planning and decision making. Obviously, yes. So, this is a true statement. So management accounting is mostly historical in its approach and it projects the past. So we are projecting the future. So this is the false statement. So option B is the right answer. Then, according to DuPont methodology, the parameters that driven return on equity is operating performance, asset usage performance, financial leverage. Everything will come under that. So option D will be the right answer. So, which of the following responsibility center is an organization unit whose manager is responsible for managing revenues and current expenses? Actually, this is a quite tricky question. So, if you have gone to the study material theory, you can easily identify this. So, if it is managing revenue and current expenses, the option should be investment center. So, most of the people will get confused between investment and profit center because of similar terms. So, if it is profit center, it should be given here as generating revenue and current expenses. So there is a difference between generating and managing revenues. So for profit center, it should be generating revenue and current expenses for an activity. So here the option answer should be investment center. Then the Laplace criterion is the feature of which of the following? So it should be decision making under uncertainty. Then fifth question, born a division of BANC Limited, a manufacturing company, has total assets of 12 lakhs and operating income of 3 lakhs. So, what is the division's residual income? Is the cost of capital is 15%. So, first we will identify what is written on investment, that is ROI we can identify. So my total assets into 15 percentage, that is 12 lakhs into 15 percentage, that is 1 lakh 80,000 is my return on investment. So my divisions RI, that is residual income, is what we earned 3 lakhs and what we expected. So the difference is my RI, right? So 3 lakhs minus 1 lakh 80,000. So 1 lakh 20,000 is will be my RI. So option should be 1 lakh 20,000. So then an employee of Doxon Limited took 5 hours to complete the first job in the assembly line. Using a 80% incremental unit time learning model, the time to be taken to complete the second unit will be. So here for completing second unit, so cumulative average time for completing second unit will be 5 into 80 percentage, that is 4 hours, right? So 4 into 2 total time will be 8 hours. So already time taken for first unit, it is 5 hours. So the difference is time taken for second unit. So 3 hours will be the right answer. Then in the factory of DOSN, using the standard costing system, the details of overhead expenditure they have given standard fixed overheads, actual fixed overheads, variable overheads, actual variable overheads, output and standard they have given. So actual output they have not given. So we need to calculate actual output only we need to calculate, and they have given fixed overhead volume variance. So usually how I will calculate fixed overhead volume variances. See, if the output is actual output is higher, so it should be my favorite, right? So I will use like I used to write like actual output minus my standard or budgeted output, whatever it is, into standard fixed overhead rate. Here I am using output, right? So here also per unit. So this is the way I used to write. So it will be easy for me. So first I need to calculate standard fixed overhead rate per unit. That means standard fixed overhead divided by my standard output. So standard fixed overhead is 80,000 divided by output is 40,000 they have given. So 2 rupees per unit. So volume variance already they have given us at was 4,000. So minus 4,000. So actual output I am writing it as X minus standard output. So my standard output is already they have given 40,000. So 40,000 into 2 rupees. So I will be getting minus 4,000 is equal to 2x minus 80,000. So minus 4,000 plus 80,000. So here it should be 76,000 is equal to to x. So x is equal to 76,000 divided by 2. That means 38,000 units. X will be 38,000. So option A should be the right answer. So FBT Limited is presently operating at 60% capacity and producing 600 units. The cost structure at 60% level of activity is material 50 rupees per unit, labor 25, direct expenses 5 rupees per unit, factory overheads 20,000, 60% variable, and administrative expenses 15,000, 60% fixed. So what will be the total cost per unit for production at 80% capacity they have asked. So here they have given details for 60% capacity. So now we need to identify the details for 80% capacity. So here they have given all the details for 60% capacity. That is at 600 units. So material 50 rupees per unit, labor 25 rupees per unit, direct expenses 5 rupees per unit. So factory overheads 20,000 into 60% is variable. So uh, I am splitting first what is fixed and variable. So fixed is remaining 40%, right? So 20,000 into 40%, that will comes around 8,000. So variable part will be 20,000 into 60%. That is 12,000 as variable. So here in the same way I'm splitting administrative expenses. So administrative expenses fixed is 60%. So 15,000 into 60%. So you will be getting 9,000. So variable will be that remaining 6,000 will be my variable part. So 15,000 minus 9,000, or you can calculate that the remaining 40% also you can calculate. However, the answer will be same. So we need to remember one point. What is that? Variable cost. Always remember variable cost per unit will remain constant and total will change. Whereas it is vice versa. For fixed cost, per unit will change, total remains constant. So this is the rule we need to remind. So what we need to calculate total cost per unit for production at 80% capacity, right? So at 60% capacity, that is 600 units. So I want to calculate for 80% capacity. That is for if it is 600 for 60%, what will be for 80%? So it will be around 800 units. Okay. So units we have, we know. So here direct material they have given per unit only. So variable cost remains constant always. So direct material is, just a second. So direct material they have given 50 rupees per unit. So here I will take as it is 50 rupees. So direct labor they have given 25 rupees. Direct expenses they have given 5 rupees. Fine. So now coming to fixed overheads, that is factory and administrative. Let me calculate. So factory overheads. So I already calculated what is fixed. So in this fixed is 8,000. So for 80% also the same will come, right? 8,000, it won't change. So then what is per unit? So 80,000, 8,000 divided by 800. So per unit will be 10 rupees. So if I'm coming to variable part, so variable is 12,000 we have calculated. So 12,000 is for 600 units, right? So per unit, so 12,000 divided by 600 per unit, I will be getting 20. So total is coming to 30 rupees. So factory overheads, total it is coming to 30 rupees. Then administrative expenses. So saying the administrative expenses, I have calculated the variable as 6,000 and fixed as 9,000. So this 9,000 will come as it is. So it won't change irrespective of my volume. So 9,000 divided by 800. So per unit will be 11.25. So and my variable part is 6,000. So 6,000 is for 600 units. So what will be for 800 units now? So it will be coming around 8,000. So per unit will be 10. So my total cost will be 21 rupees. 21.25. So my total cost of production will be 131. So the option should be 131.25. So hope this is clear. So then SNG is choosing which of the products PQR to make and as calculated likely payoff under three possible scenarios A1, A2, A3, giving the following payoff table. So we have given three scenarios and we have three products. So using Maximax, identify the product which would be chosen by the company. So if I'm choosing so they have asked identify the project which should be chosen. So if I'm choosing P, so what will be my profit? 40 plus 80 plus 100. So that will be around 220. So if I'm choosing Q, so 80 plus 100, 180, here it should be 160. But whereas if I'm choosing R, so 170, 240, I will be getting 240. So Using Maximax technique, I will be choosing R only. So product R will be the right option so that I will be getting maximum profit. So hope till now this is clear. So X, that is 10th question. So dash is defined as a budget continuously updated by adding a further accounting period when the earlier accounting period has expired. So if it is zero-based budget, we are starting it from scratch. So the option should not be a zero-based budget. So if it is in case of rolling budget, we will be continuously adding. So the option will be rolling budget. So in that, both fixed and variable costs are considered for product costing and inventory valuation. So for inventory valuation, we will be considering fixed and variable cost in case of absorption costing. That is our traditional costing technique. So option C will be the right answer. So Unicorn Limited sold 200 units and 300 units of its product in 2023 and 24. Total overhead for 23 and 24 is 10,000 and 12,000 respectively. The fixed overhead would be, so we need to calculate fixed overhead, right? So for 200 units, we are incurring 10,000. So we can calculate variable overhead based on the formula change in cost divided by change in output. So here change in cost is 12,000 minus 10,000, that is 2,000 divided by change in units, that is 300 minus 200, 100. So you will be getting 20 rupees per unit as variable cost. So if I am calculating for 2023, that is 200 units, right? So variable cost will be 20 into 200. So I will be getting 4,000. My total cost here is 10,000. So my fixed cost will be 6,000. So variable cost minus my total cost will be my fixed cost. So answer should be A, 6,000. So if PV ratio is 20%, selling price per unit is 50, margin of safety is 2,000 units and fixed cost is 30,000. The actual sales quantity is, so they have asked for actual sales quantity. So they have given margin of safety, fixed cost, everything. So let me calculate the break-even point. So break-even point will be fixed cost divided by PV. So 30,000 divided by 20%. So it should be, so 30,000 divided by 20%. So 1,50,000 would be my break-even point. So margin of safety formula is sales minus break-even point, right? So sales, I don't know. Break-even point is 1,50,000. So here I can convert this also in units. So in that way also you can calculate. So if I'm converting break-even point in units, that is 1,50,000 divided by selling price per unit, that is 50. So I will be getting 1,50,000 divided by 50. So I will be getting 3,000. So why I am converting here is they have given margin of safety in units. So that is 2,000 units they have given. So sales in units I am taking as X, break-even point 3,000. So X is equal to 3,000 plus 2,000, that is 5,000. So option C is the right answer. So AE Limited produces 500 units of product in 7,500 hours against standard hours of 8,000. If standard rate per hour is 50, then labor efficiency variance will be. So here we need to calculate labor efficiency variance. So labor efficiency variance is equal to, so labor efficiency variance is equal to standard rate into, so you can easily remember efficiency is based on hours only, so the difference should be standard hours minus actual hours, right? So here they have given 7,500 against the standard hours of 8,000, right? So 8,000 is my standard hours. So I don't know, standard rate is 50. They have given standard rate as 50. Hours, standard hours is 8,000. Actual hours is 7,500. So 50 into 500. So this is a straight question. 2,000, 25,000. So here the answer is coming as favor. So positive. So 25,000 favor. If standard hours is less than the actual hours, that is, if it is 7,000 here, then my answer will be adverse. So here it is favor. Then expected return. So expected return of two mutually exclusive project is 15%. The standard deviation of return of project one is 20%. While standard deviation of return of project 2 is 10%, the coefficient of variance of project 1 and project 2 are, so coefficient of variance of project 1 should be, uh, I need to identify, right? So formula should be standard deviation divided by my expected return. So here standard deviation of project 1 is 20% divided by expected return of 15%. So 20 divided by 15%. So 1.33 we will be getting. So option should be 1.33 and 0.66. So we will check for project 2 as well as. So here project 2 standard deviation is 10%. So 10 divided by 15%, that is 0.1 divided by 0.15. So we will be getting 0.66. So the option B is the right answer.